Let me ask you something. Think about all the advice you have been given. From your parents, from your teachers, from every adult who wanted to help you. At some point someone told you, buy a house. It is the investment you will ever make. For most of us this advice seemed true. It felt like the one move that was just safe. It felt like the thing to do. Here is what nobody told you. For people, buying a house is not the way to build wealth that they thought it would be. It is a 30-year arrangement that takes hundreds of thousands of dollars from you and gives it to the banks. The worst part is that the numbers have been there all along in your mortgage papers. Most people just never bother to look at them. Today we are going to take a look at the numbers of buying a house and see what they really mean. Welcome to Finox Finance, where we explain how money really works, not how you were told it works. In this video we are going to look at one of the common beliefs about money, that buying a house is always a good idea. We do not want to tell you that you should never buy a house. We want to show you the story, the parts that the real estate people do not tell you about. By the end of this video you will understand how a 30-year mortgage really works. You will know what you actually pay for a house and what you think you pay. You will see why owning a home helps some people get richer and why it makes others poorer. You will also learn what the system is really meant to do. Let's get into it. Let us talk about where this idea of buying a house came from, because the idea of buying a house did not just appear out of nowhere. After World War II, the United States government made a decision to make America a nation of people who own homes. The United States government helped people buy homes by giving them loans with interest rates through the FHA. They built homes in the suburbs. They told people that owning a home is a good thing, that it means you are successful and stable, and that it is part of the American dream. This plan worked. More people started owning homes. Many families who were considered middle class bought homes, and the value of these homes went up over time. When these families retired, their home was often their valuable asset. So people started telling each other to buy a house. They said, buy a house, it is the thing you can do with your money. There is a problem with this advice. The people who gave this advice bought homes a time ago when things were different. They bought homes when homes were cheaper, when interest rates were lower, and when people did not have much debt. The life they lived is not the same as the life you will live. If you think it is the same, you might lose a lot of money. The idea of buying a house is not the same for you as it was for them, because the times are different and the circumstances are different. Buying a house is still a decision, and you should think carefully about it. Okay, let's talk numbers. Make this real. Say you buy a home for $300,000. You put 10% down, that's $30,000. You get a mortgage for $270,000 at 7% interest over 30 years. That rate is pretty standard as of the mid-2020s. Your monthly payment is about $1,796. That sounds okay, right? It's like renting in many places. Here's what most people don't calculate. Over 30 years you'll make 360 payments of $1,796. That's $646,560 paid to the bank. You borrowed $270,000. You'll pay back $646,560. That's $376,560 in interest. On a $300,000 home, you'll pay for this house then twice over at current rates. The real estate industry says, but your home will go up in value. That $300,000 home will be worth $600,000 or more in 30 years. That's true in many markets. Let's be careful. Going up in value is not the same as profit. When you add property taxes, which on a $300,000 home could be $3,000 to $6,000 per year, or up to $180,000 over 30 years, plus homeowners insurance maintenance costs that usually 1 to 2% of the home's value each year, and any renovations or repairs, you're looking at a total cost of ownership that can easily reach $900,000 to over $1 million on a home you bought for $300,000. So yes, if your home doubles in value to $600,000, you've still spent way more than you got back. The math isn't as simple as the brochure suggests. Here is where things get really interesting. The mortgage system is not just expensive, the mortgage system is set up in a way that makes the bank get the money. It is hard for you to own your home. Your own mortgage system is not working for you. This setup is called amortization. The mortgage amortization is worth understanding. You should know about the mortgage amortization. When you make your mortgage payment, your $1,796 does not split evenly between paying down what you owe on the mortgage and paying interest on the mortgage. In the years, most of it goes to interest on the mortgage, not to paying down what you owe on the mortgage. For example, in the month of a $270,000 mortgage at 7%, about $1,575 of your payment goes to interest on the mortgage, and only $221 goes toward paying down what you owe on the mortgage. That is a difference. Think about that. In your payment, 88 cents of every dollar goes to the bank as profit from the mortgage. That is a lot of money going to the bank. This ratio changes over time. It changes very slowly. The mortgage amortization changes very slowly. After 5 years of payments, you will have paid over $95,000 to the bank from the mortgage, and your remaining loan balance on the mortgage will still be around $256,000. You will not have made progress on the mortgage. After 10 years and about $215,000 paid to the bank from the mortgage, you will still owe around $237,000 on the mortgage. That is still a lot of money owed on the mortgage. It is in the final years of the mortgage, when most of the interest on the mortgage has already been paid, that your payments start reducing what you owe on the mortgage. That is when you finally start to own more of your home. The bank gets paid first every month. For 30 years the bank always gets paid first from the mortgage. There is something worth noting: most people do not stay in a home for 30 years. The average American moves every 7 to 12 years. That means most people sell their home right when they have paid the interest on the mortgage and own little of their home, and then they start over on a mortgage. It is a cycle. This cycle keeps the interest flowing and keeps what you own out of reach. The mortgage system keeps you from owning your home. The mortgage system is not working for you. Now, to be fair, we are always going to be fair here on Finox. Buying a home can create real wealth for certain people under certain conditions. Let us be honest about that. If you buy a home in a market where the price of homes is going up a lot, it keeps going up. If you own the home for a time, ideally past the midpoint of your mortgage, where you start building equity faster. If you buy the home at a price that's reasonable compared to how much money you make. If you are not hurt by a drop in the market before you have built up some equity. Under those conditions, buying a home can be a way to build wealth. It is also a way to make yourself save money. For people who would not save money or invest it otherwise, making a mortgage payment every month slowly builds up a thing. That is real. That is valuable. People who buy homes to rent them out, not to live in, use the system in a completely different way. They have the people renting the home pay the mortgage. They get tax advantages from the home getting older. They can use one home to buy more homes. For them, the bank system actually helps them. Notice who that describes. It describes people who have money, a plan, and choices. It does not describe the person who is buying a home for the time and was just told to stop throwing money away on rent and signed a 30-year contract when they were 25 years old, in a market they did not fully understand. The wealth is built by the people at the top of the system. The interest is paid by the rest. Let us address the phrase that has probably pushed people into mortgages than any advertisement ever could. You are just throwing money away on rent. This idea is so embedded in our culture that most people have never stopped to question it. Let us slow down. Yes, at the end of an agreement you do not own anything. That is true. At the beginning of a mortgage for years you also do not own very much. You own a sliver of equity while the bank owns the rest. The difference is that in a rental you know what you are paying for. Housing. In a mortgage you are paying for housing plus a large financial product that mostly benefits the lender in the early years. Renting also gives you something that mortgages do not: flexibility and liquidity. The money you are not tying up in a payment and not losing to interest can be invested elsewhere. For example, index funds have historically returned 7 to 10% annually over periods. A disciplined renter who invests the difference between renting and owning costs can in scenarios come out ahead of a homeowner, particularly in expensive markets where the price-to-rent ratio is sky high. Is renting better? No. Is buying better? Absolutely not. The honest answer is, it depends on your market, your timeline, your income, and what you do with your money. Either way, what is not okay is the idea that buying's always smart and renting is always waste. This belief has never been about your well-being. It has been very good for banks, for real estate agents, and for the mortgage industry. So where does this leave you? If you are thinking about buying a home, here is what actually matters. You need to figure out the cost of owning a home, not just the money you pay for the mortgage. You have to add up the taxes, insurance, maintenance, and interest you will pay over the time you plan to live in the home. Then you have to compare that to what it would cost you to rent a home for the amount of time. Look at how much of your money will go to the home. If your mortgage payment is then 28 to 30% of the money you make each month, that is a bad sign. The more money you have to spend on your home, the money you will have to save or invest in other things. Think about how you plan to live in the home. If you buy a home and plan to move in 5 to 7 years, you will probably pay money in interest and fees than you will make from the home increasing in value. In a lot of places you will actually lose money. Think about why you want to buy a home. A lot of people buy homes because they feel like they should not, because it makes sense financially. They feel like renting a home is not a thing and owning a home is a good thing. That is just what people think. It is not about the money. Real wealth is not about doing what everyone else does. It is about understanding how things work and making choices that help you, not the people who make money from your decisions. Buying a home is a decision and you have to think carefully about it. You have to think about what's best for you and your money, not just what other people think you should do. The idea that owning a house is always a way to build wealth is not true. Sometimes people do make money from their houses. The problem is that people think buying a house is always an idea and that renting is a waste of money. They also think that the mortgage system is in place to help people get ahead. This is not the case. The mortgage system is actually in place to make money for the people who lend it. It does a good job of making money from the interest people pay on their mortgages. Now you know how the mortgage system works. Knowing how something works is the step to being in control of it. If you learned something from this video, you should subscribe to Finox Finance. We make videos every week that explain how money works. We do not make things sound better than they are. We do not tell people to take shortcuts. We just tell the truth about money. If you want to learn right now, you can watch our video about the debt machine. In this video we explain how the system of borrowing money is designed to keep people in debt.